Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's a weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Well, this is yet another of those rare times, all becoming a little too common nowadays, when I substitute my daily chart in making this weekly commentary for my monthly chart, just so I could get some idea of the definition for this market. We've seen a pretty violent move higher over the last 2 months that reached up to the previous all-time high at 1349 back in 2008 and exceeded it, if only by a little, but all made in a very short amount of time. So, that all being said, where are we and what may technically be next? Well, for starters, I can refer you to my annual review where I covered Chicago wheat in depth. Interestingly, in this review, I went back to what I call a big picture pattern that had highlighted some 3 years beforehand. I quote from my annual review: "The most important point going forward is a big picture pattern that I have outlined 3 years ago. This is what I wrote at the time, and I quote, 'The interesting concept of a descending scallop pattern for the whole of 2012 to date action so far. This pattern is not complete, but it has an interesting dynamic. The slope of the move down from 2012 to 2016 is the first element, and it looks like the long slope of an Olympic ski jump. 2017 to date is whether the market turns up at full speed and flies off at the highest point, currently in this case the 613 high from last August.' That's the end of that original quote. That August refers, of course, to the 2018 high. Anyway, here is a further piece from 3 years ago about the descending scallop pattern, and I quote again from last year, from the annual review. Now, descending scallops can be both bullish and bearish, and in this case for bullish scallop, the market takes another more ragged and shorter dip before accelerating higher. A typical move up would be about 1/3 of the length of the long ski jump onto the highest peak. In this case, it would be about 811 or about point X. It's too early to call it a target, as the market may still expand the rise. A typical move down would be about 30% off the long ski jump, taken away from the low of 387 or about the 217 level and off the bottom of the chart. It seems excessive, but I feel obliged to mention it." That's the end of the whole quote. Well, it may have seemed excessive back then, 3 years ago, but it certainly turned out to be a true pattern as prices reached point X, which turned out indeed to be target X, at 811 back in November of last year. This is now where it became even more interesting, as this confirmed descending scallop pattern morphed into a rounded bottom pattern, stretching from 2012 to date. A key feature of this pattern is the bump. You see, rounded bottoms often have a bump in the base, which looks like a false break higher. This is where the dip back in 2019 comes in, as the action from December 2017 to May 2019 was this bump, and the market did form a full and proper rounded bottom pattern. Now, this rounded bottom has caused the market to rise up, break the 2012 high at 953, and moving up to the primary target for the rounded bottom at target X1 in the 1321 area. This leads me to a possible secondary target for such a pattern. Well, that is off the top of my chart in the 1520 area. In fact, the target X2 is not completely off the top of my chart. You can see it peaking just underneath the top. Please note that such secondary targets are usually very hard to achieve. This leads back to what may be happening right now. You see, this original descending scallop pattern may be morphed into a rounded bottom, may now be morphing once again into a possible ascending scallop pattern. This very much depends on what happens in the next few weeks and days. What you should look out for is some hesitation away from this month's high and close perhaps to the very recent 50% Fibonacci line at, I suppose, 1051 area. Now, these numbers may be finessed once we get back to the daily charts. And that's also actually can be possibly down to the Fibonacci congestion at 990 or 977. As I've already mentioned, this is a possible projection from what is as yet a very incomplete and only a partial possible pattern so far. Definition of what is going on. Indeed, this may be the first chart on which I will go back from a monthly format to a daily format eventually, but not just yet. In the meantime, the long-term monthly chart shows a rounded bottom, developing from 2012 to date, and with the annual key reversal up in 2020 being the origin of the latest move up. Then early in 2021, we saw a host of golden crosses of the moving averages. This prompted a spike in early 2021, which then dipped back to, unsurprisingly, hold at the 61.8% absolute Fibonacci line at 524. And it is from there that we have seen the latest move higher. Now, all this action has two implications. The first one is that compared to the Chicago wheat, the rounded bottom here in Chicago corn is seriously lagging behind in time. Whereas the wheat has already broken up over the lip of the rounded bottom, here in Chicago corn prices are only now just approaching the significant 2012 high at 849, plus the congestion in the 799 to 806 area, both which could be seen as the second lip of the rounded bottom. However, there are two other patterns that are currently operational, both originating from the lows in 2020 and still running now. The first is formed from the previously mentioned hesitation around the 61.8% Fibonacci line at 524 and is a bullish halfway hesitation. The potential target X is in the 910 area, well above the high of 2012 at 849. The second pattern utilizes the same action but instead forms a bullish Andrews pitchfork over that action. Right now, the market is just underneath the rising middle time, currently at 787. This pitchfork is interesting, as though it does not give a potential target, as the halfway hesitation does, it seems to be giving the current bullish angle of attack. That is the situation we currently find ourselves within and the opportunities that are presented. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.